Hi again, everyone. What a jam-packed event we've had today. But then, thank goodness that all the sessions have been recorded and will be available for you to review in this site. Presentations will be also available very soon. So, a couple of years ago, I remember when I started participating in these types of events. So everything was about disruption. Everybody was talking about how fintechs were coming, disrupt, and then eat the bank's lunches. And banks were doomed, essentially. But now the conversation is very different. Today, especially in this event, but then you can see that in the ecosystem, it's all about collaboration. It's all about working together. So banks are talking about data-based decision-making, agile, AI, customer centricity. So banks are looking a lot like fintech nowadays. And then fintechs, yesterday startups, today scale-ups, or even mature companies are going to market faster, much more efficiently. Thanks to the infrastructure and the channels to market and the customer base that banks are providing. That's an awesome development. And that's one of the takeaways, I think, one of the key takeaways from our session today. Now, let's flip this. I'm going to flip this thing a little bit first. So first, I will give the credits, and then I will finalize with my presentation. And then after I finish that, I will answer any questions that are in the chat because I have to have my my presentation on full screen. So first of all, thank you to all the speakers. Your generosity in sharing all your experiences is very appreciated. And then also thank you to the attendees for your very insightful questions. So it looks like the systolic and diastolic movement of a heartbeat. So then let's think about how we think, so how cardiologists think about your heart. Before we invented the EKG, the electrocardiogram, what the cardiologists could do outside opening you up was to make an assessment of your lifestyle and how it corresponded to the demographic group that you belong to. So, they would ask you stuff like, do you smoke? Yes, I smoke a pack a day. All right, I think we need to increase your your risk for a heart attack by 5 percentage points from the baseline. Do you exercise? Yeah, I exercise 3 days a week. All right, you look about the baseline. Actually, no, I cheated. I exercise 3 times a month. Oh, actually, you are a little bit more risky. So, we need to add 1% to that. Do you have high blood pressure? No, I have a very good resting heart rate as well. Okay, maybe it's a less risky thing. So then, what people did was then they would build boxes with attributes. And then if you belong to one box, they would assign the risk of that event according to what risk that box had. And that's called cohort analysis. When EKGs came around, then what doctors could do was actually not to make decisions about how you belong to a box with attributes of other people, but rather they could make decisions based on the individual behavior of the involved organ, your heart. So they could see your specific individual behavior and then assign a specific risk to you. So then you could see that, for example, if you have a before EKGs, then you were put in a box that said, yeah, you're at a high risk of a heart attack. But what did that mean for you to have a risk of a heart attack in the next couple of weeks or days? That accuracy was actually very low. You couldn't predict with a high degree of accuracy whether or not tomorrow or the week after you're going to have a heart attack. Once we had the EKG that measured your heartbeat itself, the accuracy just shot up to something like 70%. And that's what we think how it is that we should be analyzing your current account is for determining your risk of default. Looking at your heartbeat and determining whether or not you're gonna be defaulting your any payments that you have in the short term. Then we had a new inspiration, and that was the fact that several of us who worked in this little project had been working developing noise canceling headsets. So then when we looked at graphs of your bank current accounts, we realized that those graphs looked very much like sound waves. So then we had an inspiration as well. You know, when a noise canceling headset analyzes the sound, and then it looks at recurrent sounds, and then it makes a decision whether it's noise or part of the music or the speech that they're reproducing, then they make a decision to emit the exact opposite sound wave to cancel that sound out. That's called autocorrelation. So you use statistical methods to look at previous behavior to predict future behavior. And that's exactly what bank accounts look like. So if you are like, you go to lunch at work during weekdays and have a small account expenditure on weekdays but not weekends, that's a type of recurrence, and it has so that's a frequency, and there's an amplitude, the size of the amount, which is usually not very much. But then you probably like go out and splash out, say, once every 2 weeks to a nice restaurant. Okay, that's a bigger recurrence, but still, you know, bi-weekly. There's a bigger thing that happens, and that's your mortgage payment. A bunch of small things that happen monthly as well. Your Spotify or your Netflix account. You may have like dividends that come quarterly, yearly insurance payments, etc. So then what we can see from your patterns of expenditure is we can very quickly make assessments of what it is that you're spending money on, their recurrence, and what kind of expenditures they are, without having to know whether, you know, without having to know anything outside of the fact that something happened, when it happened, and how much the amount it was. We do that because of a couple of things. The first one is that the description field for the transactions is not very reliable. You know, sometimes you get good descriptions, sometimes you don't. We have another tool to analyze that called the distance analysis. We can measure the distance between descriptions. But then when we talk to our banking friends, one of the ways that we've been trying to solve this problem of knowing classification of expenses and then knowing recurrence is to then integrate with other data sources. So you're talking here retailer information, location information, social media information even perhaps. And a lot of those integrations they have a couple of problems. The first one is that we're dealing a problem of complexity. So the complexity of analyzing things by adding more complexity. And complexity multiplies, as you all know. And the second problem is compliance, regulatory, privacy issues. So we try to be able to make an assessment of risk, recurrence, and to classify what account transactions are and what they represent without having to enter this minefield of compliance and without invading your privacy. And that allows us to make a better assessment of the risk that a particular account has, or, you know, the person related to this account has in defaulting a particular payment on a debt. So those are some of the things that we are working on nowadays. I thank you for your attention. And if, as I said, you think this is interesting, please link up or visit us, and we can have more discussions about that. Let me see if we have questions. No. Okay, so I'm open for questions now, and let's see. I don't think I see any questions. Well, in that case, I thank you for your attention. Thank you, attendees. Thank you, participants, speakers. Thank you, sponsors. And I wish you a good weekend when you get there. I enjoyed this event a lot, and I declare this summit formally closed. Thank you very much. Bye-bye.